So the Dow is solidly over 27,000 today, and today's retail numbers were supposedly great. And just last week, Jerome Powell, the new Federal Reserve chairman, gave a speech in Switzerland at the University of Zurich, I believe, saying that he does not expect, it was a week ago on Friday, that he doesn't, quote, at all expect the U.S. to enter a recession, though he hinted the central bank will likely cut interest rates as expected this month. Quote, our main expectation is not at all that there will be a recession, even though Danielle DiMartino Booth put out on her Twitter the New York Fed's own models showing that the probability of recession has spiked a lot just in the last couple months. So clearly he's lying. And I'm going to put the pieces together showing you guys from different industries that beneath the surface, beneath the stock market rising, beneath the supposedly good retail numbers, that there are a lot of problems in many different industries in the U.S., the real economy, and that will, sooner than later, the exact time frame may be difficult to predict. I would be pretty confident saying it's a very high probability of 2 years or less, probably even less than a year at this point. It would be pretty good luck if Trump could get the Fed to help him out through the 2020 election. But there are a lot of industries, guys, where things in the United States, in the real economy, despite these good retail sales numbers today, where there's big red flags, and it's just accelerating lately. So first off, before I get into some of the details and some of the stories, let's just talk about leading economic indicators. So LEIs, if you're not aware of what those mean. Almost everyone by this point has heard of the inverted yield curve and how eventually, even though an inverted yield curve means normally there will be a recession, normally there's a lag time. So it's a leading, I've covered videos on this. I'll just do a quick summary right now. It's a leading economic indicator. However, it's a lag time. The mainstream media is marching out talking head after talking head, including people from the Fed saying it's not a big deal. It could be a false positive. It doesn't really matter that much anymore. Blah, 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 blah. Okay, eventually it means recession. It's a question of when and not if. It's almost 100% accurate, an inverted yield curve. It just doesn't mean it's happening right away. So even though it's a leading economic indicator. Other leading economic indicators are things like transportation companies. So the Dow Jones Transportation Index is not crashed. So that's something that you could watch. This is DJT, Donald J. Trump. Just the kind of ironic there. So if you just want to monitor this, watch that index, the Dow Jones Transportation Index, DJT, Donald J. Trump. You can monitor that. It has not crashed yet, although it has become more volatile in the last, it looks like, year or so. It's been very volatile. If you look on the 1-year chart, it's been extremely volatile. And the Dow Jones Transportation Index is made up of the components, and these are leading economic indicators. There's a bunch of leading economic indicators. I have articles, and I'll read a definition in a second. But normally, you can tell if companies like UPS, FedEx, the rail companies, the trucking companies, the airlines, the cargo container shipping companies, if those companies are having problems. So if they announce that, we have our trucks aren't getting work, we're using less rails, our ships are empty, we're putting more of them on idle, we're shutting them down, things like that. So that would be red flags because, and this is why it's a leading economic indicator, if the goods are not moving from one part of the country to another with trucking or rail from one part of the country to another, or they're not moving from one port to another in a different country through cargo container ships or elsewhere, those goods not moving means the global economy is not doing well. And we have lots of evidence that the global economy is slowing down. The export data from Germany, the export data from Japan, the export data from Taiwan, the export data from South Korea, all bad. Doesn't match the import data into China, too. Big red flags there. We know China's slowing down. Whether you disagree with me or not on China, agree or disagree with me or not on China, I don't think you can say that China's economy is really doing well right now. There's just ample evidence that China's economy is drastically slowing down. So whether you think China's going to collapse or not, or they're going to have a currency crisis, I don't think there's any argument that China's economy is rapidly slowing down. The leading economic indicators, the definition of it is a leading indicator is any economic factor that changes before the rest of the economy begins to go in a particular direction. Leading indicators help market observers and policymakers predict significant changes in the economy. Leading indicators aren't always accurate. However, looking at leading indicators in conjunction with other types of data can help provide information about the future health of an economy. And I would say if there's multiple leading economic indicators, so there's transportation companies like FedEx, where FedEx's stock chart, FedEx has been having a lot of problems lately. Their 1-year stock chart from a year ago, their stock was at $255.44. Today it's down quite substantially to $174.10, and they've been having a lot of problems lately. FedEx has. The other transportation companies, a lot of them in the US are not having the problems yet, but I'm going to be talking about some other stories where the rails and some of the other companies may be having some problems in the near future. So the multiple, I would say if there's only one or two leading economic indicators that are flashing red, that are showing that there's going to be an official recession, and we know the reality of the situation, guys, here in the United States. The reality of the situation is it doesn't matter if the government says there's not an official recession. What matters is the reality to the people on Main Street that you're getting killed with stagflationary depression, that your cost of living is increasing on the everyday items, that new taxes are being layered on, and old taxes are being increased. And the government's, depending upon which state you live in, they're looking to increase your property taxes, and your income has not gone up for many people. And people like me did not benefit from the Trump tax cuts. Everyone did not benefit from the Trump tax cuts. So the leading economic indicators, the yield curve is obviously one of them. And the yield curve globally, there's tons of inverted yield curves all over the globe. And the US's yield curve, despite the recent spike, a lot of the yield curve is still not doing well, even though more money has come into the U.S., although it looks like recently that trade that was Stanley Druckenmiller's betting on zero interest rate policy, and a lot of hedge fund managers, I've talked about this at length for the last week or so now, have copied Stanley Druckenmiller since earlier in the year, and it looks like that trade's being unwound because they were using leverage. They took their profits, they leveraged up and went long bonds betting on capital gains, and they've taken their profits. And it looks like now they may be going into stocks, but they're beneath the surface. In the real economy, there's a lot of red flags. The retail numbers can be good, especially for online sales. And I think online sales are good for consumers. So there's a chance there to shop prices around and compare prices and get coupons and get free shipping and free returns. And you can potentially save more money because you're not paying all the added costs that get added into the price of a retail good at a retail store. However, and this is the thing about economics. Economics is all about trade-offs. However, if you go back, and I haven't heard anyone else talking about this, if you go back and look at all the supposed job growth, guys, since the 2008 financial crisis, since our quote-unquote recovery, almost all the job growth, the majority of the job growth has come in three major sectors. It has come in restaurants, it has come in retail, and it has come out of the shale oil boom, out of energy. Those are the three main growth drivers of job growth in the United States since the 2008 financial crisis. And there is a good case, and I will make it in a little bit on the show, reading news stories, talking about this, that there is big busts coming, especially in oil. So I want to prove my point here further. I went and looked up an article from May 13th of 2015. The oil price had just started to correct back then, and this was from the Pew Research that does the polling, pewtrust.org. And they tracked from 2009 to 2015, they tracked the percentage change in employment. So which states had the most job growth after the 2008 and 2009 financial crisis? And guess which state had the most job growth? I'm not sure it's this way anymore because the oil prices have been dropping, but the state that had the most job growth was North Dakota. North Dakota had almost a 29% in employment growth since April of 2009. That's how many jobs. So all those jobs were either directly related to oil and natural gas from the Bakken and shale oil, or they were service jobs that were catering to the oil workers, the people running the oil rigs, the people. So they were restaurants, they were people running restaurants or working in restaurants, they were people at shops and Walmarts. I have friends who went up there for a year or two, up to the Bakken, graduate students. I think either they were in grad school or they had just graduated grad school, and they went up to the Bakken for a year or two to go work there during the oil boom, and just hearing some of the stories from them. So those jobs, guys, are very dependent on oil price. And also the amount of money that those oil companies can raise. So if the oil price, which is looking pretty weak lately, it's in the low 50s still. Last time I looked at it, I'll pull it up right now. We're at oil prices barely a little bit below 55 on WTI at 54.97 now. Gold prices down below 1,500. It may stay a little bit lower. It may go a little bit lower for the next couple weeks or a month or two, but I still expect, this is not financial advice, just my opinion, I still expect to see gold higher by the end of the year, testing 1,600, probably 1,650 as of now. And certainly within 6 months or a year, based on the stupid behavior that these governments and central banks are going to continue to do, all this talk of zero interest rate policy, negative interest rate policy, in the short term, anything can happen. Things can go a little bit lower. The paper price manipulation can smash things a little bit, but there is smart money. Not everyone is doing it yet, but there is smart money buying the dips. So 6 months, a year from now, I think we're going to have a lot higher gold and silver prices. There's going to be a lot of volatility and corrections along the way. If it goes straight up, that might mean a system crash is imminent. That might mean that would be a warning sign. If gold goes like what happened with Bitcoin, where Bitcoin went very quickly from a couple $1,000 up to 19,000. Okay, so the job growth. Back to the job growth in this 2015 article. A lot of the job growth, guys, was in the major oil states. So there was Texas. Texas had a 15% job employment increase because Silicon Valley also moved there to escape taxes in California. They got tax breaks in Texas, and it was a lower cost of living and also lower taxes in general in Texas, except for property taxes if you buy a house, from what I hear. And so Texas and North Dakota had some of the largest job growth after 2008, and a lot of that's directly related to energy. If you also go back and look up the job growth numbers during the Obama administration, a lot of those job growth numbers were in part-time jobs in restaurants and retail. And guess what's happening? The retail apocalypse. So earlier this week, the Wall Street Journal ran an extensive story about the retail apocalypse. I don't have a subscription to the Wall Street Journal, but there are articles that are summarizing this out there. You can find them. Michael Snyder was summarizing this, I think, in an article a couple days ago. It's Fed Chair Powell insists there won't be a recession when the evidence suggests otherwise. And so far this year, there's been a record amount of retail store closures. The retailers have announced the closing of more than 8,200 stores in 2019, and we're going to break the old record for store closings in a single year by so much that the term retail apocalypse just doesn't seem sufficient to describe the scale of what we're witnessing any longer. So these retail store closings, yes, there's going to be a lot more online sales. That's what the mainstream financial media is going to be talking about. Online sales, consumers fine, no problems. The consumer confidence index, people are consuming. Walmart is busy. People are trading down. People are going to Walmart and Target and grocery stores, okay. But the consumer, in my opinion, just does not have a lot of discretionary income. I've already talked in the last couple weeks about how there were stories from CNBC and elsewhere of the more affluent people are now stopping spending their discretionary income. So you have that. And there's been a number of chains recently that just closed. I think that just from January to June of this year, guys, there was more retail store closures from January to June of this year than there was in all of 2018. So we are on a really big pace. And then you add in the fact that when I go to stores like Home Depot, and Home Depot is using less humans. So Home Depot, my dad and I were running some errands, and we went to Home Depot for an errand, and we checked out basically by ourselves. There was a Dell touch screen there, and there was a a hand price checker, a hand price swiper, one of those hand units, and a hand scanner, and we just scanned the prices, and we checked out ourselves in and out. So automation, you combine all these factors with the consumer is looking to save more shopping online. These stores are looking to save costs, and they don't want as many human employees that are automating more. So that means less humans at the checkout counter. You have Lowe's and others that are trying to use these robots now for answering questions at the store. And that's going to hurt jobs. So we're going to see this eventually in the jobs information. I believe also the data that came out, I was seeing Peter Bookvard put this up on his Twitter yesterday, that the prices in the Fed's own core CPI are starting to rise. They're up like 2.5% in core CPI increases. And the jobs data is showing that even though some people's wages are up, less hours per month are worked. So we're starting to see this play out. The retail apocalypse is getting worse. It's not just, there's a combination of factors involved. Why? But the bottom line, though, is that when more people shop online, that means less bricks and mortars, and that was a large growth driver for jobs. Even though those were not high-paying jobs, they were still jobs. And the government, especially the Obama administration, was counting those in his 8 years as job growth. And a lot of restaurants are not doing that well either. There's shrinkflation there. People are realizing this. A lot of people are blaming capitalism for the shrinkflation. They don't really understand exactly what's happening, that their fiat currencies are being devalued and other things like that. I tried explaining it to my dad exactly about the shrinkflation, and my dad's a doctor. He just didn't want to hear it. He was just really angry at Olive Garden for reducing the size of his shrimp scampi portion by more than half in only like 6 months. And no, I don't eat at Olive Garden often. My dad dragged me there. He likes Olive Garden. He doesn't eat very healthy. So I appeased him once. So let me talk about some more of these stories. More evidence that the real economy is doing bad. Zero Hedge has been covering this. So we have the trucking recession. So this goes back to the leading economic indicators. Heavy-duty truck orders have collapsed. Production is slashed. Cancellation orders soar. This story came out last week on September 7th. So Zero Hedge has been tracking this every month now, orders in trucks. And so the new reports are showing that the amount of trucks are down, I think, more than 80% year over year, the truck orders. So it's only the bare minimum of replacements. I was looking at a graph of it, and some of the orders used to be like 50,000 new trucks per month, and now it's down to 10,000. So it's collapsed. It's just absolutely collapsed for new truck orders. And those trucks, replacing those trucks, upgrading those trucks in 2018, when the narrative was the economy was still doing well, there was less bad data. The data hadn't started to accelerate yet because the Trump tax cuts were still creating a temporary stimulus on the real economy, especially for small business and corporations. That a lot of firms ordered a lot of new trucks back then. A lot of these heavy duty, Class 8? Yeah, net orders of heavy trucks. It's collapsed. In July of 2018, it was over 50,000 new trucks net orders. And now it's down to 10,000. There's a chart here in the Zero Hedge article. So I would call that a leading economic indicator that the truck orders have collapsed. That these companies that are running these trucking companies and the truckers, they're cutting their expenses. You have CEOs who are jumping ship. You have CEOs who are enormous net sellers of stocks. So despite the Dow being over 27,000, you have corporate insiders who are enormous net sellers of their own shares, despite using, and some of these companies are so unethical. Mark Zuckerberg did this, where they were doing billions of dollars of share buybacks, and that was to soak up him dumping his own shares. So the Facebook stock didn't crash while he unloaded an enormous amount of his own shares. So CEOs abandoned ship. A record 159 CEOs have exited in August as overall layoff surge. And then The oil problems might be the largest problems, and you're not hearing them talked about in the mainstream media, because a lower oil price is good for the U.S. consumer. However, like I said, the job growth, there was an enormous amount of job growth based on the oil and energy industry, based on the shale industry's ability to raise cheap capital and junk bond debt and cheap equity. And those days look over. There are oil stories. I don't know if you guys saw this. One of my listeners sent me this earlier today, and I went and researched it. I should probably do a separate video on this. But the Russian central bank is now planning for an enormous bear market in oil, a complete and total bust. And they're prepping their entire economy for a $25 barrel per barrel oil next year for a big bear market, a big bust. One of the largest oil busts in the last 10 or 20 or 30 years. And on top of that, you have, I'll read some of these articles. You have U.S. shale firms cutting budgets, staff as oil price outlook dims. Oil producers and their suppliers are cutting budgets, staffs, and production goals. So a leading economic indicator, guys, I'm not sure if it's officially included in there, but a leading economic indicator, in my opinion, would be capex cuts. So if companies are making investments into their business, if they're making a lot of investments, if they're willing to make the investments for growth capex, then they're seeing a brighter future. If they're cutting back capex and they're raising cash, they're slashing inventory levels, they're clearing inventory for cash, they're selling things at a discount to clear inventory to raise cash, they're tightening down the hatches, they're tightening their belt, these are all red flags. So watch the capex spending. There are places that track this for capex spending for different industries, and the oil industry, it looks like, is doing big capex cuts. Like, we're talking enormous employee layoffs, we're talking delaying investments into a lot of oil equipment, a lot of well upgrades, things like that. So the U.S. has, let me read this article, I think it was from last week. The U.S. has 904 working rigs, down 14% from a year ago, and even that is probably too many, estimated Harold Hamm, chief executive of shale producer Continental Resources, which has reduced the number of rigs at work. Bankruptcy filings by U.S. energy producers through mid-August this year have nearly matched the total for the whole of 2018. A stock index of oil and gas producers hit an all-time low in August, a sign investors are expecting more trouble ahead. Quote, "You're going to see activity drop across the industry," Earl Reynolds, CEO of Chaparral Energy, told Reuters at the Enercom Oil and Gas Conference last month. The Oklahoma energy firm has slashed its workforce by nearly a quarter, so 25% drop in its workforce. Ouch. For the local economy, imagine that if you're a town in Oklahoma near oil rigs, or Texas, a small little town, and you are so reliant on oil workers, and all of a sudden the workforce dropped that much. So the CEO, okay, I found where I was reading. Trimmed its spending plan, so capex was cut. So not only did they fire a quarter of their employees, they cut capex spending by 5%. That's not a massive number, but you have to keep watching that number to see if it goes lower. And agreed to sell its headquarters and use some of the proceeds to reduce debt. So you're seeing oil companies sell assets for pennies on the dollar. Guys, I hope I'm wrong about this, because I have friends working in the oil industry now. I have one friend who just lost his job, and I have other friends who are working in the oil industry in the United States. I really hope I'm wrong, but it looks like there's going to be a very, very big bust in the oil industry in the next 2 or 3 years. I hope I'm wrong about that, but the lower oil price would be good for consumers. It would be bad for the employees who lost their job, because they're not going to be able to consume, and it's going to be probably tough for them to find as good a high-paying job at some of those oil jobs as they were getting. So investment bank Cowen and Company estimated last month that oil and gas producers spent 56% of their 2019 budgets through June. Based on its review of 48 companies, it expects total spending this year to fall 11% over last year based on proposed budgets. So an 11% capex cut doesn't sound like too much, but if it's a trend. So like I said, it's a leading economic indicator, and if you start to see even more capex cuts in oil, you're going to see that the industry is hunkering down for a big bear market and trying to protect themselves from bankruptcy. The slowdown in drilling is spurring cost-cutting in oil field services. If you want to see some really ugly stock charts, guys, take a look at the deepwater offshore rig companies like Seadrill, Transocean, Diamond Offshore,
A few of those other ones. Transocean in particular, that chart looks very ugly. Seadrill, I've talked about this for a year now. When Seadrill was IPO'd, when they went from privately held after their first bankruptcy a few years ago, and then they went from a private company back onto an exchange, and I was looking at their balance sheet, the creditors and investment bankers who redid the company, who supposedly reorganized the company, they did an absolutely poor job with Seadrill. Seadrill was owned by a Norwegian billionaire, and they owned a lot of really good deepwater offshore rigs. But Seadrill, when I looked at the balance sheet last year when oil prices were higher, I said this company is not going to make it. Because the company had over $5 billion in debt and only about $50 million per year in free cash flow. And they had a lot, so the debt was delayed out a number of years, but it was just a mess. The balance sheet was still a mess. I couldn't believe they left the company with so much debt. It was just truly tragic. And Transocean shares do not look good. Transocean has had to idle a lot of their older rigs. So that company, that balance sheet looks like a mess. Transocean, if you listen to I was reading the conference call transcripts last week, it sounds like Transocean thinks that the oil market's close to bottoming. I do not agree. Sounds like they're too optimistic. I do not think the oil market's close to bottoming. They think that they're positioned for an oil market rally. I do not agree. I think the global economy is slowing down a lot. And then the oil service companies, your Schlumbergers, which I've talked about. The Schlumberger, to me, looks like a yield trap. That stock chart is really ugly. Halliburton chart does not look good. I would not be buying this is not financial advice, just my opinion. I would not be buying the dip on any oil company right now. And maybe I should do a separate oil show tomorrow or the next day. I could talk about that Russian oil projection report later. So there's just been big capex cuts. The oil service companies are slashing their budget. They're cutting their prices. And there's been a lot of people fired lately. There hasn't been an enormous amount of bankruptcies yet in 2019, but it looks like, guys, that later in the year or in 2020, maybe 2021, there's going to be, barring a miraculous turnaround in the oil market, there's going to be a very, very big bust. There was a lot of waste with a lot of credit, a lot of misallocation of capital in the oil boom, especially here in the United States with the shale boom. Because so many drillers drilled on debt and never produced the earnings or the free cash flow that they promised their investors. So I hope I'm wrong about that, but it does not look good. So there's one more story here from Zero Hedge from yesterday. Shale boom cools as employment in oil and gas jobs tumbles. About 11,000 oil and gas jobs have been slashed from the prior year. These jobs were mostly in the oil and gas support activities. There's a chart here showing the drop. U.S. mining jobs are dropping too. So, and not only that, you have Farmageddon. So the Midwest is getting hurt. They're losing their oil jobs in the Midwest. They're losing, the farmers are getting killed financially with the trade war, with the tariffs on farming goods, and all the other problems. I outlined that. I did a show last month on that, with all the different problems that farmers are dealing with, whether it's grand solar minimum, or some areas there's flooding, some areas there's droughts, the crops didn't go well. You have the Chinese tariffs on a lot of, where soybeans were one of the major exports for American farmers to China, and now they can't sell any, or it's very little. So you add all these things up, and it just looks like that a lot of the country is going to be dealing with major, major pain. If they're already dealing with major pain, that things are only going to get worse in the near future. Especially with how the Federal Reserve wants and the U.S. Treasury, Donald Trump administration, President Trump even, he tweets about this all the time, they want a weaker dollar. So it's looking like people are going to be looking for cheaper, less paying jobs, and they're going to be killed with stagflation and more stagflation and taxes. Low gas price equals low inflation. That's only on gas prices. And if the consumer was working in the oil industry, he just lost his a higher paying job potentially in the oil industry, and has to go to a lower paying job. So it's all about trade-offs and weighing things.
So you have big red flags in the oil market. You have farmers. You have retail, problems with retail. All these retail stores are closing, going bankrupt, going to online sales, which means less jobs for human beings. Unless you want to be entrepreneurial and you want to build your own online business and sell a product, and you're actually good at it. Shale bust will benefit Canadian oil industry after short-term pain. I disagree, because the Democrats control Congress and they're going to block the pipelines. That Canadian oil has to get, it either has to be sent by ship to Asia or it has to be pipelined down to the Gulf Coast refineries. And if you have Democrat politicians controlling Congress, the Democrats don't have 2/3 majority, supermajority in Congress, but there is still a possibility that there could be a Democrat president in 2020. There needs to be more pipeline capacity for that Canadian oil to get down to the refineries. Otherwise, it's going to still trade at a discount. So, Jerome Powell, speech a week ago, lying that there is no recession. The Federal Reserve's own models are showing that a recession is high probability of a recession. Recession is imminent. I have a chart of this in the Wall Street for Main Street Facebook group. It's from Danielle DiMartino Booth's Twitter that she put last week. And that's the Fed's own models. So people inside the Fed are obviously very wary that a recession is coming soon. And Jerome Powell is the chief propagandist. I would want that job. Powell's already rich. Why the hell does he want that job? He's going to get blamed for this mess. He inherited an enormous mess. There's nothing, the Fed was trapped already. There's nothing he could have done that was going to fix things. He could only have made things worse. The Fed was trapped. Once Bernanke started doing the stuff Bernanke was doing with zero interest rate policy, and then the corporations went crazy with the debt borrowing, and their credit ratings weren't downgraded. So once Bernanke went to ZERP and the Fed expanded their balance sheet like crazy, that was it. It was a question of when and not if. The Fed was trapped. All these central banks are trapped now. Yeah, Trump is trying to shift the blame. I don't know how successful it's going to be. We'll see. There's a lot of factors killing farmers right now here in the United States. It's truly sad. So there's a lot of warning signals, guys, that the official recession, using the government's numbers, is imminent. Almost definitely less than 2 years, probably even less than a year now. We'll see if the Fed prints money, increases QE. I did some research into that, what people were saying that the Fed started doing QE again. The Fed only bought $14 billion worth of bonds, expanded their balance sheet. Now, after how much money has been printed, and in my opinion, it's at least $65 trillion since 2008, at least. It might even be a lot more than that, but that's the number that I can confidently say of fiat currency and credit that has been created since 2008. If you look at $14 billion that the Fed expanded their balance sheet by last month in buying treasuries versus the $65 trillion globally that's been created, it's nothing. I'm not sure what the per capita GDP in the US is. So the global economy, guys, is slowing down very, very rapidly. It's been getting worse now for the last year or two. And the talking heads on mainstream financial media, mainstream media, are saying, oh, the U.S. is not in a recession. There's no signs of it. Well, eventually, if the global economy is slowing down a lot, it guarantees the U.S. is going to feel the pain. Because we do have a global economy. We have global supply chains. And everything is connected in one way or another. There's if you're not familiar with how the food gets to the grocery store here in the United States or other westernized countries, there's a just-in-time supply chain. And during the 2008 financial crisis, when the commercial paper markets froze, we were very close to not having any food at the grocery store. And that's why the Fed stepped in and did that crazy $16 trillion.
of interest-free loans and bailouts to back the commercial paper market and others. I don't like giving a lot of price targets for gold. I just think that gold is going to be going higher because there's a lot. David Stockman just did an interview last weekend saying that potentially $90 trillion worth of corporate and government bonds could all be negative yielding in the next couple years. Thank you, Jesse, for the super chat. I appreciate it. Jonathan Royer, thank you for the super chat. Thank you, Greg, for the super chat. Jonathan's asking if he should short Royal Dutch Shell. I don't know specifically. I haven't looked at Royal Dutch Shell. Now they did have a lot of investments into LNG, so they were selling LNG at a very high profit in Asia, but it's really high capex. ExxonMobil just put a lot of investments into shale, and they're telling people that they're going to get 10% or higher returns on invested capital into their shale wells. I don't believe them. So I think this is just my opinion, not financial advice. I think ExxonMobil, because they're making investments into shale so late in the cycle, I think they're having problems. I looked at EOG Resources, and I think EOG is by far the best shale oil producer. They're actually generating free cash flow now, and their balance sheet, they said it has the lowest debt level since 2008. But I wouldn't be long EOG right now. I would wait. I really like the company though, operationally. EOG, the investors presentation, like they're very honest with all their figures. It looks really good. But I would wait on EOG. I wouldn't be long anything oil right now. You may get a pop if oil has a brief rally, but I mean, unless OPEC decides that they're going to cut a massive amount of oil production and they're actually going to stick to the production quotas, and OPEC always cheats. There's always at least a couple OPEC countries that always cheat on the quotas because so many of these OPEC countries need the almost all of their government revenue, their economic revenue for a lot of these OPEC countries. Some of these OPEC countries, their revenues are like 80 or 90% based on oil. So they don't have a diversified economy and all. So that means even when the oil prices crash, they need to sell more oil on volume to make up the difference for their social program spending, for their government budgets, things like that. If you guys want to see a really good video about a cartel, a documentary, go watch the Netflix series Dirty Money. Remember, they had that full episode on the HSBC Bank. There's also one on the Quebec Canadian maple syrup cartel and how they pushed up. There's a strategic maple syrup reserve. I didn't know this. There's a strategic, I'm not joking, there's a strategic maple syrup reserve. And over the last like 10 or 15 years since the cartel was formed, the price on Canadian maple syrup has gone up like enormously. And there was a big, like 10 years ago, there was a big maple syrup heist. And a factory, one of the crane operators inside the warehouse where all the strategic barrels of maple syrup were stored, a forklift operator was in on the scam, and they replaced the barrels with fake maple syrup, and they were stolen on the black market, and like $20 or $30 million worth of, no, it's not a joke. There's a Netflix show about it. It's in the Dirty Money series on Netflix. I'm not joking. There is a maple syrup cartel. I try to keep the show interesting to keep you guys on your toes and laugh. I'm not joking. Go and watch the Dirty Money series, the Maple Syrup Cartel. I was laughing the entire time. There was a Quebec maple syrup farmer talking about how good the cartel was and how great it was with higher prices, and then the farmers can earn such a great living. And I was like, yeah, because you're putting in price controls and manipulating the supply. Yeah, you guys have to see the story. It's a really good episode. I was laughing and it kept me on the edge of my seat. No, the maple syrup cartel has not been around for 100 years. It's been around for, I think, like 15 or 20 years. Because they interviewed the guy who was the head of the maple syrup cartel, and he said that his father was a maple syrup farmer and could barely pay his bills.
Okay, let me look at listener question. Let me make sure I got all the stories that I got covered. I got other stories on this if you want to take a look. But to summarize things up in just a couple sentences, all the industries that had all the job growth since 2009, so retail, restaurants, those aren't high-paying jobs. Those are mostly either part-time or low-paying full-time jobs, hourly wages. They're having a lot of problems lately, okay? Retail apocalypse and others, a lot of people, the consumer is switching to e-commerce, online sales, and while that's good for the consumer, cheaper prices, it's bad for human beings who need jobs. So you have those industries hurting. That means less people employed there. You have a lot of stores closing. You have entire companies going out of business, going bankrupt, retail stores, bricks and mortar. So it's not all bad. The consumer is getting lower prices, but human beings then are not finding the jobs. And then you have the oil industry, which was an enormous job creator, the shale boom, this cheap equity, cheap junk debt boom since 2007, where almost very little free cash flow, very little consistent earnings, almost no dividends were paid out, despite the promises from some CEOs for every single year for 10 or 11 years. So the three major job growth drivers, guys, in the United States, those are all looking bad. And then you have Jerome Powell a week ago from today lying, saying there are no signs of a recession. He knows damn well it's coming. It's a question of when, not if. I'm not managing money professionally. I'm not trying to time this perfectly. There's hedge fund managers making these bets, trying to time this stuff perfectly. Boring Name says you have enough supply, you can create a cartel for just about anything. Actually, no, you can't. You have to have the government protecting you. You have to have the government courts, the government, the police, the military. You have to have that. You cannot have a cartel without the government protecting you. So if you're a maple syrup farmer in Quebec and you don't want to be part of the cartel and you sell outside the cartel, you're risking going to prison. You cannot have a cartel without the government protecting you. That's how the Federal Reserve works. The Federal Reserve's a cartel. It's a banking cartel run by the large banks. Without government protection, they wouldn't have it. Bugsy maple bacon. And that's why the cost of maple syrup, if you buy the authentic stuff, is going to keep going up. Oh, and then there's the black market maple syrup trader. There in that show, there's a black market maple syrup trader, and he wasn't even in Quebec. He was in another part of Canada, and the Quebec police then went to his warehouse in another part of Canada, and they confiscated everything and almost bankrupted him. I mean, this is a crazy story. You got to see this. I'm not a maple syrup expert because I don't really have sugar anymore. You guys would know that better than me. Jim Rickards called the Fed a poorly run hedge fund levered 113-1. Yeah, I would agree with him. I don't know their leverage ratios. Guys, all these central banks are hedge funds now. The Bank of Switzerland created a euro peg, right? To peg their currency, the Swiss franc, against the euro. And in only 3 years, running a euro peg, the Bank of Switzerland created $300 billion out of thin air. They then took that currency and started their own technology investment fund, hedge fund. I just read articles from August. There's a quote from a Reserve Bank of Australia, which is Australia's central bank banker, talking about how in Australia they do currency trades with leverage and hedges. That they were using yen carry trades and other currency hedges with leverage. So yes, all these central bankers, guys, are all now doing hedge fund trades. That's how desperate things are. There's actually a great book about the banana industry and United Fruit. I think it's called The Fish That Ate the Whale. It's a really good book. It's about the history of United Fruit and how the original bananas were all destroyed and how what we have now at the grocery store for bananas are not real bananas. No, I don't watch the Kaiser report anymore, but it doesn't surprise me. Depopulation because of negative interest rates. Well, he's there. It's destroying people's retirements. It's destroying saving. It's destroying people's retirements. They're not going to be able to get investment income to retire. And then you add it, Jack, and then you add in stagflation increasing on all the everyday items we need, shrinkflation, and in taxes layered, either new taxes layered on or old taxes are increased, like property taxes and others. And it's just a bigger and bigger shit sandwich that the people in power are trying to shove down our throats. Of course Powell is lying, but I don't even know why Powell wanted the job in the first place. He's worth around $100 million, maybe more. It's not like he needs another pension. He could go sit on the beach somewhere. If I had $100 million, I wouldn't want to be Fed chairman right now. I wouldn't want to be lying. I wouldn't want to be anywhere near this mess. Hey, Brian, glad you can make a live stream show. Guys, Fed cutting, not cutting, doesn't matter. Doesn't matter. The Fed could cut and the dollar might not weaken. They want a weak dollar. What's the dollar index at now? Dollar index is still, I think, above 98. Yeah, it's at 98.22. They want a controlled devaluation of the dollar. All these countries want a controlled devaluation of their currencies. No one's going to get everything they want. Every single country can't devalue exactly how they want to devalue without any unintended consequences or things going off the rails. If I was managing money, if I was a hedge fund manager, just hypothetical, the bets that these hedge fund guys, and remember, if you haven't listened to the interview with Tavi Costa from Crescott Capital that I did last Friday, go listen to it. And what these hedge funds are doing is they're setting up bets, betting on what collapses first, and then the aftershocks of what happens after what collapses first. Okay, guys, well, I'm getting pretty tired here. I may do another show later today, or I'll do another show tomorrow. Thank you guys for your time. I just want to thank my almost 150 Patreon account contributors now. Thank you so much. Some of you guys are emailing me questions and things like that. I get over 3 dozen emails per day, so it's hard to answer all of them and still have a life and still put out content. It's hard to do that. So I will email some of you back. It's hard to email everyone back. So thank you, though, for emailing me. I appreciate it. And thank you very much to my almost a dozen monthly PayPal account contributors. I really appreciate it. You guys are really making my life a lot easier right now because, at any point, YouTube could just decide that they're going to stop the growth of my channel. They're going to take all my ad revenue away, even if my channel's growing. And then, it's back to square one again, even though I'm busting my ass. I think I've taken 1 day off now in the last 4 months or so for not making content. Okay, well, everyone have a good weekend, and if there is any more breaking news or any interesting stuff, or Trump says something really outlandish or crazy in one of his tweets, I will probably do a short update. Okay, bye for now.